Get ready to dive into a critical topic and brace yourself, because the worst housing crash of our lifetime might be just around the corner. Are you prepared to face the storm and safeguard your finances and future? As property values take a nosedive, foreclosures reach unprecedented levels, and interest rates continue to skyrocket, it's becoming evident that this housing crash is not a distant possibility, but a looming reality. Don't wait until it's too late to act. Watch until the end to discover what you need to know to protect yourself from the upcoming financial catastrophe. Your future depends on it. Please support our channel with a thumbs up, and don't forget to subscribe to our channel. The housing market has been on a wild ride over the past few decades, but what's coming next could be the biggest crash ever. With stagnating wages, rising interest rates, and a ton of risky loans flooding the market, experts are warning that we're headed for a cataclysmic meltdown that could leave millions of Americans destitute. The signs are clear. Skyrocketing house prices, risky mortgages, and excessive debt levels have market analysts predicting a massive bubble burst. As per Mark Zandi, the chief economist at Moody's Analytics, the housing market's current state is highly unfavorable to potential home buyers due to several factors. Mortgage rates have soared to unprecedented heights, pricing homes out of reach for many, and there is also a need for more available properties in the market. In his expert opinion, this is the bleakest period for home buyers ever in history, and the situation is going from bad to worse. While it's not an ideal time for buyers, sellers undoubtedly benefit from the high demand and low inventory, resulting in a seller's market. The spike in mortgage rates can be attributed to a combination of factors, including inflation, rising interest rates, and a general sense of uncertainty in the global economy. The pandemic has disrupted supply chains, causing construction delays and further exacerbating the problem of limited inventory. Recently, the Federal Reserve's efforts to stabilize inflation have been attributed to a noticeable increase in mortgage interest rates. The surge in inflation that began in 2021 has now reached the highest level witnessed in the past 4 decades. To combat this, the Federal Reserve has boldly raised its federal fund rate, the interest rate at which financial institutions such as banks and credit unions exchange federal funds, 10 times since the beginning of 2022. This aggressive course of action taken by the Federal Reserve is considered to be the most aggressive pace since the 1980s. It is essential to note that the effects of these actions may be far-reaching and felt across various sectors. While the Federal Reserve has indicated that it will pause rate hikes in the short term, it is unclear whether further rate hikes will be required. Joel Kahn, the deputy chief economist at the Mortgage Bankers Association, states that the Federal Reserve is implementing measures to control inflation, which is likely to impact the home buyer demand and purchase origination volume in the year 2023. The reason is simple. Fed rate movements significantly impact borrowing costs, ultimately affecting mortgage rates. As a result of the ongoing affordability challenges, homebuyers may have to reconsider their options as the rates become less and less favorable. Consequently, the current situation poses a challenge for mortgage lenders, who will have to take steps to adapt to the changing market conditions. This means the mortgage industry will likely face some turbulence in the coming years. Thus, borrowers and lenders must keep an eye on the Federal Reserve's actions, as it will directly impact the mortgage industry. Recently, the rates for securing a mortgage have increased dramatically to 7%. This is the highest rate recorded since the year 2002. It is actually more than double the amount that most people were paying for their mortgages at the start of the pandemic. As a result, this has caused a significant increase in the monthly amount most homebuyers would pay, reaching up to 77% more than last year's rates. Realtor.com says this has resulted from inflated housing prices and rising interest rates. For instance, consider a median asking price of $425,000 with a 10% down payment. At this present moment, this purchase demands an additional $1,117 from the buyers every month. The high home purchasing costs are making it an even more challenging task for average homebuyers to cope with. In May 2023, another real estate company, John Burns Real Estate Consulting, was predicting the future national housing market. At that time, the mortgage rates had just reached 5%, and the firm stated that home prices should decrease by 10% by 2024. However, as mortgage rates continue to rise, Rick Palacios Jr., the director of research for John Burns Real Estate Consulting, believes that the actual decrease in home prices will be greater than the initial prediction. Housing experts are cautioning that the upcoming year may prove to be an arduous one for the industry due to several factors. Firstly, the towering mortgage rates and inflated home values are making it harder for potential home buyers to purchase. Secondly, due to the economic recession, there has been a significant decrease in the demand for properties, particularly luxury ones. The unfavorable combination of circumstances is expected to make the housing market less favorable in the year ahead. Despite the ongoing uncertainty in the housing market, experts in the field believe that it is unlikely we will see any substantial reduction in house prices similar to the drastic dips experienced during the Great Recession. Rob Dietz, the chief economist of the National Association of Home Builders, concurs with his contemporaries, stating that they all anticipate a moderate downturn. Recent trends reveal that although house prices have fluctuated in certain areas, the housing market has remained relatively stable overall. The data indicates that the market has remained buoyant compared to the recession years, with the demand for real estate consistently surpassing its supply. According to a statement by Craig J. Lazara, the managing director of S&P Dow Jones Indices, the housing market in the United States displayed signs of improvement through April 2023. The latest released figures showed a sharp rise in home prices in June 2022, followed by a decline through January 2023. However, the market began to recover after that point. This implies that more people were buying and selling homes during this period, with an increasing demand for them. In other words, the U.S. housing market was seeing a boost in its growth and stability. Despite the recent economic improvements, there are still concerns regarding the housing market. Over the past few months, mortgage rates have been escalating rapidly, which has resulted in a significant decrease in home sales. Many are now worried about the potential consequences of this situation. On June 14th, Federal Reserve Chairman Jerome Powell spoke to the media regarding the issue. Powell acknowledged the sensitivity of the housing market to interest rates, stating that it is one of the first sectors to be affected. Lower interest rates tend to stimulate home buying, whereas higher rates have the opposite effect. Powell emphasized that the Federal Reserve will monitor the situation closely to ensure that no further harm is caused. This issue impacts many individuals since owning a home is often considered the most significant investment a person can make. Therefore, monitoring the housing market and making any necessary changes before it is too late is crucial. The Federal Reserve's efforts are a sign that they are taking the matter seriously and willing to make essential interventions if needed. The financial crisis triggered by the collapse of the subprime mortgage market resulted in a heavy toll on people's lives, with many losing their homes and leading to an overall economic downturn. The consequences of this crisis were severe, particularly for Americans who found themselves amid a financial catastrophe as their home's value plummeted far below the amount they had initially borrowed, leading to a surge in subprime interest rates. This crisis had ripple effects in both the national and global economy, with widespread implications on the employment sector, personal finances, and international trade. The magnitude of the subprime mortgage collapse has been one of the most significant financial events in recent history, and its lingering effects continue to impact various aspects of society to this day. In conclusion, to boost and maintain economic stability, the Federal Reserve should consider lowering the federal funds rate to nearly zero. This organization is responsible for decisions that influence employment and economic growth. The federal funds rate represents the interest banks pay when borrowing money from each other. Decreasing these rates would allow people to have more capital for reinvestment in the economy. Therefore, considering the projected changes, it is reasonable to conclude that the housing market is unlikely to experience significant upheaval, despite facing some uncertainty ahead. Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.